It's great to talk to you today. What I want to talk about is the economic path forward. We've had a systemic risk realization, and the real question is just how much long-term damage has been done to our economy. We know the human damage is tragic, but what about the economic damage? What will this recovery actually look like? And that's what I want to talk about. So I've been interested in recessions for quite a long time. Some of you know that my dissertation at the University of Chicago discovered a relationship between the slope of the yield curve and future economic activity. So when the long-term interest rates went below short-term rates, or the so-called yield curve inversion, that preceded economic recessions. So I'm actually a bit surprised. I graduated at Chicago given that my sample was 4 recessions. So I was 4 out of 4. And indeed, some committee members were a little skeptical. However, the economic foundation of the idea was sound. After I published my dissertation, indeed, this is usually what happens. You publish something and the effect gets weaker or goes away. That wasn't the case for my dissertation. The next 3 yield curve inversions preceded recessions, including the global financial crisis. So let's fast forward to June 30th of 2019. The yield curve inverts for a full quarter. And I go on the record saying, code red, yield curve is inverted since the 1960s 7 times and 7 recessions. So you got to take it seriously this time. You didn't in 2007. So people were listening to me, and I wasn't alone. The survey that Duke University does of CFOs across the country and the world, we've been doing that for 25 years, and over 50% of those CFOs thought that there'd be a recession in 2020, and that was increased to 80% if you included the first quarter of 21. So there was expectations that there was economic weakness ahead. But then a systemic event hit, the COVID-19 virus, and we went into recession. We'll never know if the yield curve prediction would have been accurate because the counterfactual is impossible. We don't know what the world would have looked like without COVID-19. But nevertheless, we're in recession. And this recession is a remarkably easy one to date. So if you think about the dating committee of the National Bureau of Economic Research, often they date the beginning of the recession after the recession's over. There's a lot of uncertainty about the date of the beginning and the date of the end. Well, in this one, there's no uncertainty. The peak of the business cycle, February 2020. And then we went off the cliff. So what is different about this crisis and other recessions? So it's not that many recessions, again, and with quality data, we're now talking about 8 recessions. Each one is different. But almost all of the recessions are induced by economic or financial factors. So for example, the global financial crisis, that was induced by a financial event. So our banks were acting like hedge funds. They had extreme leverage. And then when an event happened that didn't seem like a really big event, given your leverage, you get into trouble. And that's exactly what happened. And then the policymakers, afraid of the aftershocks to the economy, trying to mitigate the damage, had to go in and bail out these financial institutions. And at the time, and even right now, kind of repugnant to go in and dole out billions of dollars to companies that did a poor job of risk management. Indeed, that sort of incentive just causes a replication of the same behavior in the future. But it was done. And it was relatively easy to do. You can call in the 25 CEOs of the largest financial institutions and just hand them out checks. Okay, so this crisis is different. So the number one thing, which is obvious, is that this is not a financial cause. It's a biological cause. So we can't point our fingers at a particular sector or a particular set of firms saying, oh, it's your fault. Indeed, the whole concept of bailout doesn't make any sense. So you bail out a firm that's basically had, in the global financial crisis, poor risk management, you have to bail them out. This particular crisis is more like giving aid to some companies in terms of bridge financing that were high quality companies. These were companies that were profitable, making capital expenditures, growing their workforce. But then they got hit by essentially a natural disaster. Okay, so I want to pursue the natural disaster analogy just a little bit. So the cause of this crisis is biological. The end of this crisis is also biological. So you think about the two main forces are a pharmacological solution to decrease the fatality rate if you get this virus, and a vaccine. A vaccine effectively is the all clear. So it's very clear that the solution to this crisis is biological. So compare this to the global financial crisis. The global financial crisis, we had no idea how long it would actually last. It went on and on. Indeed, the official ending of the Great Recession is September 2009. However, unemployment continued to increase after the official end of the recession. Indeed, unemployment didn't get back to the level that it started at in 2007 until May of 2016. So that's like 9 years. And it was really confusing for policymakers also because people didn't know if we're still in recession or not. Growth was anemic. Interest rates were kept low for a very long period of time. And people talked about a lost decade of growth. People compared it to the Great Depression. This crisis is far different. And it's different because the uncertainty is different. Yes, it's true at the beginning of this crisis, we saw all these exponential curves and people were fearing the worst. However, we've learned a lot more. We've learned that the initial infection fatality rates were vastly overstated because many people contract the virus and have no idea that they have it. We also learned that there's a long history in academic publishing and epidemiology whereby you see exponential growth at the beginning and then you hit an inflection point and it starts to decrease. And these virus patterns are very common. So we learned a bit about epidemiology. And of course, the two key things that will mitigate the biological threat, the pharmacological sort of mitigation of symptoms and vaccine. Again, we're learning about that too. So we've got many drugs that are being tested, and we've got a number of vaccines in trial. So again, this is different because there are pretty solid expectations that we will have a biological solution by the fourth quarter and potentially deployed in the first quarter of 2021. So again, you see the light at the end of the tunnel. And in other recessions, that just wasn't possible. The clarity is so different than other recessions. So what does this mean? So it means that on various different fronts, that the uncertainty drives different policy responses. The uncertainty drives different psychological responses. So, for example, in the Great Depression, you lose your job, it's just very difficult to find work anywhere. And you lose your job for a very long period of time. In the global financial crisis, let's say you're working for Lehman Brothers, you get laid off. Well, you're not going back to Lehman Brothers because Lehman Brothers gone down. And hard to go to another company because many of them are under stress. And who knows when you're going to get a job. Well, fast forward to today. People being told that they're furloughed for 2 months. And many expect to go back to their job. That's way different. That's way different. Policymakers also. So think of the global financial crisis and the debates in Congress about spending. And one of the issues was, well, how long is this going to last? So we can't spend all of the money because we might need to go back if this is prolonged. Well, this particular crisis, there is this biological light at the end of the tunnel. So it allows policymakers to basically use their ammunition. That's a difference also. So what are the potential risks here? And I'd like to talk about a few of them. The way I see it is, the numbers are awful. The official unemployment rate of 14.7% is vastly understated. And I challenge you to do the math. The math is really simple. The unemployment rate is just a survey number. So all you need to do is to take the workforce in February of 2020 and then look at the sum of the initial claims, March, April, and May. And then add in the unemployed in February of 2020. Okay, divide by the workforce. That's not 14.7, it's 23.9 at least. So we're headed to 30% unemployment. And then people say, well, that's like the Great Depression. So Great Depression, we had unemployment of 25%. So technically, unemployment records only began officially being kept in 1948, but the 25% is a pretty decent estimate, I'd say. And yes, that's exactly the case, that the rate could be higher than it was in the Great Depression. But that doesn't mean that we're in a Great Depression. So again, the key to understanding this is the uncertainty is different. In the Great Depression, people were unemployed for a very long period of time. It was very discouraging. We didn't have the social safety net that we have today. But more importantly, there's an end that we can see to this particular crisis. And the attitudes are different. So we've seen these numbers. The second quarter in terms of economic growth will be stunning. It'll be off the chart. Be like minus 30% on an annualized basis. The third quarter, there's not going to be any growth. It's going to be flat. But by the fourth quarter, things will start to pick up. And we will see significant growth in the fourth quarter of 2020 in terms of my forecast. And I believe that a vaccine will likely be deployed in the first quarter of 21. So this recession, again, is really unusual. Actually, I've called it the Great Compression. So in a few weeks, we lost the equivalent number of jobs that we lost during the Great Recession. So you get a lot of bad news that's really compressed. So what can go wrong here? And let me end with kind of warnings here. So what we don't want is structural damage to the economy. And by that, I mean high quality companies that were profitable, that were, innovating. We don't want them to go down because of this natural disaster. If those companies go down, that will delay the recovery. That will basically haircut future economic growth. Yes, those companies can be replaced with new companies, but there are all sorts of fixed costs of getting up and going. So a lot of the policy response has been focused on mitigating these structural issues so that high quality companies can be in stasis during this crisis and then reemerge. So what I worry about is that there will be confusion and this policy will not be successful and we lose many of these businesses. And again, it's much more complicated because this is not 25 financial institutions that you can easily call into one room. There's like 30.2 million small and medium-sized businesses in the US. So the other thing I worry about, and this is really important, we have to pay for this. This is not like a regular natural disaster where a hurricane hits Louisiana or Florida and the rest of the country is okay. This is a natural disaster that hits everywhere. And we are borrowing and we need to pay it back. So we're borrowing from the future. So how do you do that? Well, there's two ways to do it. Number one, you raise taxes, and that could have a negative impact on growth. But raising taxes is really difficult. Nobody wants to raise taxes. No politician wants to raise taxes. It's political suicide. So the other thing that I challenge you to think about is the specter of inflation. And yes, it's true, after the global financial crisis, people said, well, all this QE, there's going to be inflation. But there's no inflation. Well, I'd be very hesitant to extrapolate from a sample of one. So just because we didn't have inflation after the global financial crisis doesn't mean we're not going to have inflation in this particular episode. And yes, it's difficult to think about because we've got deflation right now, but it is a significant risk. So that is something that impacts companies negatively and people negatively, including the people that can least afford it are taxed by inflation. So I believe inflation is the major risk.